that, you know, has that black and white approach. It's almost like a tick sheet, to be fair. And to be honest, it was very. I started doing it very subconsciously. I didn't really start teaching until a year ago when I was trading this style, or maybe 2 years ago now. But I was kind of just trading this way, and it was second nature to me. I've been in the game for 7 years, and people started asking me about it, and I'm thinking I have no idea how to explain this or how to teach this or how to build some form of education around it, because I was just doing it. It was just natural to my trading. So it allowed me to create some more in-depth rules, more strict rules in regards to how to use it. And that's pretty much how I do it now and how I teach it now. So we'll crack on into it and talk about the structure first. And I'll just draw it out on this chart as best I can. And we'll just crack on. And any questions, you can obviously pop them in comments and stuff. And I'll keep a little eye on them and things like that.
Definitely.
So how a lot of people look at structure is obviously in the form of higher highs, higher lows, uptrend, downtrend, yada yada. It's very, very easy. So it'll look something like this, just got a simple uptrending market. So we'll talk about it quite simply. We've got a high, we've got a higher low, we've got a higher high, higher low, higher high, higher low, and a higher high. So the way that I typically look at structure when I'm looking at an uptrend like this is I like to define the highest point. All right, I like to define the highest point of that trend. Now, I don't tend to do it with a wick, because I know that's a question people will probably ask. Do you use a wick to define the high, or do you use a close, right, the bodies? Typically, I'll use both. I'll normally use both, as long as the close has come above the previous high. So what I'd be saying is this is the highest point of the trend. Simple as that. It's very easy, okay? What I would then do is look at where that leg came from, all right? Where the impulse, leg, push, whatever you want to call it, where did that come from? Which we can all quite clearly see is this point here. So what that becomes is the last significant higher low, okay? Now there's higher lows and there's last significant higher lows. And you're probably wondering, what is the difference? The last significant higher low is the one that will change the trend. It's the one that holds the most importance to the trend, whether that remain bullish or whether that flip bearish, okay? So that's why I call it the last significant higher low. And again, I have no idea where that terminology came from. I just said it one day and that was how I named it, all right? So this is what I'm using as the last significant higher low in this scenario. And let me show a little example of, when it would still remain significant, because a lot of people will see something like this and they'll look at this section right here. They'll start focusing and fixating on this, okay? And they'll look at it and say, okay, well, we have a lower high and then we have a lower low. And now you're looking at this little section saying we're in a downtrend, right? But what you need to remember and what you need to take into account is that while we still trade above the last significant higher low, we're going to remain bullish, right? We're going to remain in an uptrending market. And there's a number of occasions, quite recently actually, not this week because GJ is ranging, but last week and also in dollar Swiss, I believe last week and 2 weeks ago, the same scenario sort of played out where people are looking to identify this as a possible downtrend, and that's just not the case. And we all do the same thing, right? I certainly don't, but beginners do. They'll draw in a trend line, right? The old magic trend line. They'll draw in the fib. You've got your fib from your low to your high. You're looking for that 61.8 pullback, your golden number. And then what you're looking to do is you're looking to short it as we come back up and test. But then the majority of the time, what ends up happening is something like that, right? We start to flip bullish. We start to remain that bullish trend. And the reason behind that is because we maintain structure based on our last significant high. I trade structure. That's the way that I look at it. So I never, ever look to take sales unless we have a proper structure flip. And I know this might sound simple to a lot of people, or people might be going, that actually makes a lot of sense. It's just a rule that I apply to avoid getting caught in these sort of deeper retracements or things that may look like a downtrend, but in actual fact, this just becomes a whole range now. This whole area between the high and the last significant higher low, which is, let's just mark it in. Anything that happens inside here is completely irrelevant now. Anything that happens, it means nothing. This is the high. This is the last significant high or low, and that is it. So you know that you're in an uptrend until any of those break. If we start to break up above the high, we're still in that uptrend. And what we must do at that point, same as before, the first step, identify the highest point of the trend. Right here. Okay? Very easy. Simple. Identify the high. Next step, where did the push come from? Where did that leg begin? Right here. Okay? So right at this point, this is where we started. So your last significant high or low, that was once at this level here, has now moved over. All right? It's now shifted over to this point. And this is your new last significant high or low, and this is your new higher high. And that's how you work the trend. Okay, that's how you do it. And you'll always see these little corrections in here. A lot of people are going to see it and focus on, okay, this is the transition, this is the trend flipping. It's not. Okay, the majority of the time, 70%, 80% of the time, it's not the case. What's going to happen is we're going to continue to push up. Okay, so that's basically your uptrend. I guess we don't need to do the downtrend, but we'll go through some transitions now just to walk through it. But again, as we've done, we've identified a high. There's your last significant high or low. Market pulls back, pulls back again, creates a lower high, lower low. Again, we know that this is completely irrelevant. All right, pulls back again. And then on this occasion, we start to break. So now this is the point where it's important because we've broken below our last significant high or low. All right, so that structure has now flipped. Now this applies on, I want to say any time frame because market structure at the end of the day is market structure. It's driven by price action. But I only really use the market structure on daily, 4 hour, and then the 30 minute. You can use the hourly. The reason that I don't, which will likely be a question that's asked, is because I feel like if I'm waiting on the hourly candles to close, I might miss a move by that point. So I use the 4 hour candles and structure in correlation with the daily and of course the 30 minute, but tend to execute more on the 30 minute as I'll miss less moves if I'm using 30 minute candles as opposed to 1 hour candles. But you can apply it on any time frame and test it on any time frame, but it will apply the same way. And this is just structure at the end of the day. This is just market structure. It's not directional bias. This doesn't define the way in which I want to trade overall, because whilst you have one time frame bullish, one time frame bearish, which one do you use? And we can talk about that at the end as well. But as I say, this is now significant. There's a level of importance here because we've flipped that structure, and what's happened is we've now created a new low. Okay, so we've broken structure, and what we must do at that point is the exact same thing. Identify the lowest point of the trend. So while we're in the uptrend, we're identifying the highest point of the uptrend. Now that we've flipped structure, we start identifying the lowest point of the downtrend, which is of course here. And then again, same way, where did that leg originate from? Where did it come from? Well, we can quite clearly see that we've had this little pullback in here and then the drive down. So we know that the leg came from this point. So we now know that structure will remain bearish as long as we respect this level. And that doesn't mean that we can't pull back up to it. That doesn't mean we can't do something like this, and retest it again and then drive down. Irrelevant. It's irrelevant. It is still below this level, and whilst it continues to respect that level, we are bearish. All right, so anything that happens, again, in between your lowest point and your last significant lower high means nothing. Okay, it's still bearish. We should still be looking for selling confluences, okay? So again, that's what a transition would look like. And again, same way, if the transition changes, something like this, now you start to say, what's the highest point of the trend? Now I know some of the questions that we get sometimes are going to say, it's over here. It's not. This is a new trend, right? We're into a completely new trend now. So what you can say is, this is trend number 1. This is like information or trend number 2. This is trend number 3. So you're into a completely new trend now. So anything that's happened before is now irrelevant. These levels are now just used as support and resistance almost. So now because we've broken above that last significant lower high, flipped into the uptrend. So again, Same theory applies. Highest point of the new uptrend. Where did the push come from? Quite simply here. Easy as that. All right, and that's how I'll trade the structure. And it's very simple. It's very rule based. There's no guesswork involved. It's just an easy way of trying to apply price action trading and what the trend is. So, and as I say, I've used that for the last 3 years, 3.5 years, maybe a year to a year and a half of not knowing that that this is how I was doing it, or not necessarily explaining that this is how I was doing it. But that's just the way it was, and this is how I teach now, and this is how I always try to show people that work out what the trend is first. Work out what this structure is suggesting on daily, on 4 hour, on 30-minute, and then determine what your bias is going to be. Because if you've got 2 of your time frames or 3 of your time frames all working out that they're in a bullish trend, then you know exactly what to do. You know that you're just looking for areas of support to form. You're looking at clean zones to the left-hand side. You're looking at these zones where price action was clean before, that you'd expect it to be quite clean again. And that's examples that I can now go and show